Hi, this is Bill Spaulding. Welcome to WCS Money Tutorials. I will talk about one of the best investments in 2023 that will soon be available for sale. I will also explain why I believe this will be one of the best investments for 2023, much better than the stock market, even in good times. Free of risk, exempt from state and local taxes, potential capital gains may exceed 100%. With interest rates high, the stock market probably is not going to do well in 2023. However, there is one security that will do better than most of the rest, the 30-year Treasury Inflation-Protected Securities, otherwise known as TIPS, because it not only offers significant interest and adjustments to principal according to inflation, but has the greatest potential for capital gains, even better than the stock market. This video will explain why, and why the 30-year TIPS and not the shorter-term issues has the greatest potential for capital gain. And no, you don't have to hold it for 30 years to earn this money. If the economy enters a recession, then you may profit sooner than you think.
TIPS are issued only in electronic format, with maturity terms of 5, 10, or 30 years.
As a hedge against inflation, the principal of TIPS is adjusted according to the Consumer Price Index. Interest is paid every 6 months. The interest amount is determined by the principal, adjusted for inflation, multiplied by the interest rate, which is fixed for the life of the bond. At maturity, the greater of the adjusted principal or the original par value is paid. The adjustments to principal depend on the index rate, equal to the reference CPI for the applicable date over the reference CPI for the dated date, which for originally issued TIPS is always on the 15th of the month of settlement. The adjusted principal equals the par value multiplied by the index rate. The interest equals the adjusted principal multiplied by the interest rate. The adjusted principal at maturity will equal the par value multiplied by the index rate for the date of the maturity. The index rate is published every month by the U.S. Treasury. The reference CPI is for an inflation-protected security, the index number applicable to a given date. Unlike other bonds, including other treasuries, most of the value of TIPS comes from the principal adjustments. These principal adjustments determine the amount of interest paid and the value of the accrued principal in the secondary market or at maturity. The index rate is determined by the reference CPI for the dated date. The lower this value is, the higher the return, both in the form of higher interest payments and a higher final principal repayment. The Bureau of Labor Statistics releases data every month, usually on the 12th of the month, on the Consumer Price Index for the previous month. The U.S. Treasury uses this information to publish the reference CPI and index ratios for all outstanding TIPS. Note that the reference CPI for the first of the month equals the CPI of 3 months earlier, so the reference CPI for February 1st, 2023 equals the CPI for November 2022. The reference CPI for the remaining days of the month is linearly interpolated between the reference CPI for the first of the month and the reference CPI for the first of the following month. You will need this information if you sell in the secondary marketplace, because the accrued principal will depend on the index rate on the day of the sale. The U.S. Treasury has many more details on how all this is done, so if you want to know more about this, check out the details on their website. The important thing to remember is that the dated date is based on the reference CPI for the 15th of the preceding third month, and this reference CPI serves as the base CPI for determining the principal adjustments, which are then used to calculate the interest payments and the final principal repayment. Here's an example of a 30-year TIPS that was issued in 1998. Note that the annual interest payment equals 6.66% of the original par value, almost double the coupon rate, and that the adjusted principal is almost double the original par value. The annual interest payment is divided by 2 to calculate the semi-annual interest payment, since there are 2 payments per year. The coupon rate for TIPS is low compared to other treasuries, because much of the return is in the form of principal adjustments. A primary advantage of TIPS is that they offer a real rate that will not change over the life of the bond, while the nominal rate for treasury notes and bonds could drop below the inflation rate, resulting in less purchasing power.
To compare the yields of TIPS to treasuries, you must consider the inflation rate plus the real yield. The nominal yield of most bonds and other treasuries consists of a real yield plus a portion of the yield that compensates for inflation. The total return of TIPS equals the coupon interest rate plus the principal adjustment according to inflation. The break-even inflation rate is the rate of inflation that equalizes the total return of TIPS with other treasuries or other bonds with coupons paying a nominal yield. The fixed interest rate is determined by auction. Auctions even allow negative real yield bids, but if the bid yield is less than 0.125%, then the yield is set to 0.125%. If the bid yield exceeds the minimum, then the interest rate is adjusted downward to the highest multiple of 0.125% or 1/8 of 1%. The price is adjusted accordingly.
If you want to learn more details about TIPS, check out my other video on TIPS, which provides more basic information. A link is provided in the description below.
TIPS are not subject to state or local income taxes, but they are subject to annual federal taxes on both the semi-annual coupon payments and the adjustments to principal. The tax and adjustments to principal is often referred to as phantom income because you must pay the tax annually even though the principal adjustments are not received until the security is sold or matures. Therefore, it is best to hold TIPS in tax-advantaged retirement accounts.
This summarizes how taxable income is calculated.
You should receive Form 1099 OID from your custodian, showing the amount of interest paid in Box 2 and adjustments to principal in Box 8. Although it is not necessary, some custodians may choose to report the annual payment of interest separately. If interest payments are not reported on Form 1099 OID, then the interest income is reported on Form 1099 INT in Box 3.
You can add the coupon rate to the inflation rate to get an approximate value of the annual increase in your return. As you can see in this example for a 5-year TIPS, the total return is slightly less than the coupon rate plus inflation rate, compounded annually for 5 years. To understand bond pricing, you must understand the concept of present value. The present value is the current value of a payment that will be received in the future. Discounting is the process of determining the present value of a payment from a known future payment, or future value. The future value of a dollar is simply what the dollar or any amount of money will be worth if it earns interest for a specific time. For example, if you put $100 in a savings account paying 5% interest annually, then that $100 will be worth $105 at the end of the year. Therefore, the present value of $105 1 year from now, using a 5% discount rate, is $100. Bond prices are determined by the present value of the coupon payments plus the present value of the par value received at maturity. Present value is calculated using market interest rates, so therefore, bond prices change with changing interest rates. The value of a TIPS cannot be determined this way because the cash flow is unknowable, since it depends on future inflation rates, but it can be estimated by using an average inflation rate, such as 2 or 3%.
To understand the strategy that I will present in this video, you must first understand how interest rates affect bond prices. The prices of investment-grade bonds moves inversely to interest rates. When interest rates rise, bond prices decline, and vice versa. Bonds with longer remaining terms have greater interest rate risk, as you can see in this graph that shows how bond prices vary with interest rates for a 10-year bond versus a 3-year bond. The curves intersect when the bond price equals par value and the market interest rate equals the coupon rate. For instance, if a bond pays a coupon rate of 6% and interest rates decline from 6% to 4%, then a 10-year bond will increase in value by 16.35%, while a 3-year bond will increase by 5.6%. If interest rates increase by 2%, then a 10-year bond will decline by 13.59%, while a 3-year bond will decline by 5.24%.
Duration measures the sensitivity of the market price of a bond to changes in interest rates. Duration is the weighted average maturity time of all payments. Graphically, the duration of a bond can be envisioned as a fulcrum placed under a seesaw so as to balance the weights of the present values of the coupon payments and the principal payment. Both a longer term maturity and a lower coupon rate results in a longer duration. A longer duration means that a security could be sold for a higher capital gain when interest rates decline. Although duration is a useful measure, the duration of TIPS cannot be measured. Duration depends on future cash flows, and because both the interest payments and the principal payment depend on the adjustments to principal, which, in turn, depend on future inflation, there is no way to measure the duration of TIPS. Nonetheless, it is certain that the duration is long, since the term of the bond is 30 years, and most of the cash flow occurs at maturity. This table illustrates the potential for capital gains. Because future cash flows for TIPS is unknowable, I displayed what the theoretical prices would be for the 30-year Treasury bond, when interest rates decline from 5% to 0.25%. As you can see here, if interest rates decline to 1% or less, then you will have a capital gain exceeding 100%. This could happen within a few years. How long would it take for the stock market to double? Because the duration of 30 years TIPS is even longer, the price should increase even more when interest rates decline. But even an interest rate decline of only 2 or 3% can result in capital gains of 40% to 67%. Interest rates are more predictable than the stock market because the Federal Reserve, also known as the Fed, controls interest rates, mostly by adjusting the Fed funds rate. The Fed has the goal of maximizing employment while keeping inflation to about 2%. The Fed also promulgates its intention ahead of time so that people know what to expect. When inflation increases, then the Fed will increase interest rates to subdue inflation, especially if unemployment is low. So the unemployment rate and the inflation rate are good indicators of future interest rates. The federal funds rate influences bond prices because it also influences other interest rates, causing the other interest rates to move in tandem with the federal funds rate. For instance, as you can see in this graph, the changes to the bank prime loan rate closely parallels the changes in the federal funds rate. If the federal funds rate drops to 0.25%, then capital gains on a 30-year TIPS may exceed 100%. If you think it is unlikely that the Fed funds rate will drop to 0.25%, consider the fact that it has dropped below that rate 3 times since 2009. Keep in mind that these calculated prices are theoretical. Other factors will also affect prices, although interest rates are the primary determinant. Also, duration declines as the number of years till maturity declines, but with 30-year TIPS, the potential for capital gains will be significant for at least the first 5 to 10 years. Another thing to note is that while the income paid by the federal government in the form of interest payments and principal adjustments is exempt from state and local taxes, capital gains from sales are not exempt, so you may have to pay state or local taxes on your capital gains if your locality taxes such income. Bond prices decline when interest rates rise. The price of TIPS can decline even with hefty inflation adjustments, which occurred in 2022. Therefore, it is best to wait until interest rates have peaked before buying long-term bonds, including TIPS. Because inflation has been rising, the Federal Reserve is continuing to raise interest rates to subdue that inflation. They are expected to raise interest rates again by at least 0.25% in its meeting at the end of January 2023. There will be at least 4 more meetings before August. Because inflation is coming down, the Federal Reserve may pause or even stop raising interest rates, but they will probably raise it again 1 or more times in the 6 months before August. Interest rates are expected to rise 3 more times in 2023, topping out at about 5.1% before the Fed pauses, probably before August.
This is the auction schedule for Treasury Inflation-Protected Securities, showing the auctions for original issues and for reopenings. Reopenings are simply another sale of a previously issued security, having the same maturity date and coupon interest rate as the original issue, but with a different issue date and purchase price.
My recommendations are based on some projections. While the projections are reasonable, I could be wrong. It's happened. The Federal Reserve will increase the interest rate by 0.25 point on February 1, 2023. Interest rates will continue to increase during the 7 months afterward, though there may be some pauses to better gauge how the higher interest rate is affecting the economy. The Consumer Price Index will continue to decline. Higher interest rates in August means that the price for the August issue will be discounted from par value. It will have the same coupon rate, but the price will be lower, so the yield to maturity will be higher. If you buy a bond and pay a price different from par value, then there will be a gain or loss when the bond matures, when you receive the par value of the bond. Yield to maturity incorporates this gain or loss. The formula for yield to maturity is rather complicated, but it's easier to understand how the market price affects the yield to maturity. If you pay less than par value, then the yield to maturity will exceed the nominal yield because you will have an additional gain on the principal. If you pay more than par value, then the yield to maturity will be less than the nominal yield because you will have a loss on the principal. Because you may be able to buy TIPS at a discount in August, the yield to maturity will be higher than the coupon rate. Here, you can see the auction results for the reopening in August 2022. Note that the coupon rate is 0.125%, or 1/8 of 1%, the same rate as the February original issue. However, since interest rates have risen dramatically between the February original issue and the August reopening, the TIPS were sold at a substantial discount, more than 15%, giving this issue a yield to maturity that better matched the higher interest rates current at that time. This table shows the 2 30-year TIPS that were sold in 2022, showing the lower price for the August issue. Interest rates will likely rise some more in 2023, probably before August, so by buying in August, you may be able to buy at a discount, though the discount will not be as significant as it was in 2022. The other reason to wait is because inflation is declining, which means if you buy in February, your principal will probably be adjusted downward at least through August. So, buying in August means that your reference CPI will be lower, which will result in higher interest payments and a larger principal adjustment when you sell or when the bond matures. This will not make a big difference, but it is something you might want to consider. Now, let's go over the details of the August calendar for the 30-year TIPS. The auction will take place on August 24th. The issue date is the 31st. The dated date is the 15th of the month. This is an important date because it is the date when interest starts accruing, and the reference CPI index for this date will serve as the base for determining principal adjustments, which will also determine the amount of interest earned. When you buy TIPS, you must also pay for the accrued interest plus the accrued principal from the dated date to the issue date. You will get the payment for accrued interest back with the first interest payment, but you will only get the accrued principal back either when you sell the bond in the secondary market or at maturity. These are the relevant dates in February.
You can buy TIPS either at TreasuryDirect or through your broker.
When buying TIPS at TreasuryDirect, you can only buy new issues through auctions. You can buy before the announcement, and you can buy in multiples of $100 rather than the $1,000 most brokers require. However, to sell in the secondary marketplace, you must transfer the securities to a broker. This is a quick overview of what is required to transfer securities from TreasuryDirect to a broker. As you can see, it requires mailing in a paper form, so you might want to do this long before you intend to sell your securities. Buying TIPS at a broker makes it easier to sell. You can also buy TIPS for your retirement account, which would allow you to avoid the annual taxes. However, the minimum purchase is usually $1,000, and purchases must be in multiples of $1,000. Brokers only provide the option to buy newly issued TIPS for the 1 week between the announcement date and the auction date for the securities. So you should mark your calendar to remind yourself of the upcoming dates if you wish to buy. I think there is a good possibility that the Fed will stop increasing interest rates by August. But if that is not the case, it may be better to wait until February 2024 to buy. If the Fed looks like it will increase interest rates even beyond February 2024, then it may be better to wait until August 2024. The best time to buy is when there is some certainty that interest rates have peaked. I am recording this video in January 2023, so you will be in a better position to evaluate prospects by the time August rolls around. The future price of TIPS will also depend on future inflation. If inflation is high, then prices will also be high. Although inflation in the past has typically been around 2%, which is the Federal Reserve's preferred rate, it will probably be higher in the future because there will be some need to pay off the enormous federal debt, especially when politicians are reluctant to raise taxes. Moreover, because of that debt, if another crisis occurs, such as another pandemic, then the federal government will have no choice but to print more money, since raising taxes then would be calamitous. And when calamities occur, TIPS will also benefit from the flight to quality, when people minimize risk by selling risky securities, then using the proceeds to buy safe securities. U.S. Treasuries are the safest haven, so they benefit the most from the flight to quality. So here's a summary of the advantages of buying 30-year TIPS. No credit default risk, exemption from state and local taxes, and interest and principal steadily increase. You can profit from decreasing interest rates from the flight to quality during economic turmoil. And you have the potential to earn substantial capital gains, possibly even doubling your money within a short time. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.